chart patterns. They are actually called price action patterns or chart patterns. Chart patterns are the technical patterns that the market presents for traders to see whether the market is at a reversal or a continuation level. In other words, we have types of price actions chart patterns, which are reversal patterns. The reversal patterns are the patterns that show the market is at a turning point or about to change direction. And then we have continuation patterns, which are the patterns that show that the market still has to continue towards the same direction by forming a correction first. Then we have bilateral patterns, which are the patterns that can either signal a buy or a sell. When you trade such patterns, all you have to do is wait for a breakout and retest. Let's continue, guys. Okay, firstly, we're starting off with the reversal patterns. This is part 1, guys. We'll mainly be focusing on reversal patterns. Alright, so the first reversal pattern is a double top. Now, what is a double top? Double top is a market rise that is characterized by two successive high points at a resistance level that show a decline of the market. In simple terms, it is an M shape that indicates a bearish reversal in a trend. Alright, and then a lot of people actually get confused when it comes to a double top, guys. A double top is actually like an M formation. It is an M formation, right? So we'll talk more about entry levels as time goes by. But then, in order for you to enter, you have to wait for a breakout of a neckline, alright? This dotted line is actually called a neckline. So in order for you to enter, you have to wait for a breakout of a neckline. That's when your double top is actually confirmed. Okay, because on the left we have a first top, then on the right we have a second top, right? So in other words, we need to have two peak formations in order for our double top to be confirmed. Then we have to have a breakout of a neckline, right? After having a breakout of a neckline, our sell will actually be confirmed. Double tops actually predict a sell, right? A bearish movement in the market. So let's jump to the next slide. We have a double bottom. A double bottom is actually the opposite of a double top. It is a W shape in the market that signals a bullish price movement. Okay, so these patterns, the reversal patterns, guys, usually form at the end of a trend, right? At the end of a trend, that's where the reversal patterns form, right? Like now, the trend has been moving down. At the end of the trend, the market formed a double bottom. The market formed a double bottom at the end of a trend, and then it formed two peak formations, right? Which is the first bottom and the second bottom. After forming the first bottom and the second bottom, we broke out of a neckline. So after a neckline breakout, that's where we actually take a buy. So that's where our double bottom chart pattern gets confirmed after a neckline breakout. Then we have a head and shoulders pattern. A head and shoulders pattern is actually a chart formation that appears as a baseline with three peaks, where the outside two are close in height and the middle part is the highest in height, and it predicts a bearish movement. So guys, think of a head and shoulder as a human being, guys. Like a human being has a left shoulder, then the head is high, then the right shoulder is at the same height as the left shoulder, guys. So that's basically how a head and shoulder is. The first shoulder has to be a bit lower, the head has to be high, then the second shoulder has to be lower. But then that doesn't mean the head and shoulder always has to have both shoulders at the same height. They cannot be at the same height at all times, guys. Sometimes you'll find that the left shoulder is actually a bit higher than the right shoulder, or the right shoulder is a bit higher than the left shoulder, but then the head always has to be high. For example, at this point, guys, at this level, as you can see, at this level, guys, we actually had the left shoulder here at this point, and then the head was a bit higher, then the right shoulder was lower than the left shoulder, as you can see over here. All right, so it was confirmed over here that we had to take a sell after a neckline. After a breakout of a neckline, it's a confirmed sell. Okay, guys, so we actually have to always wait for a neckline breakout in order for us to take a sell. So let's jump to the next slide. Then we have an inverse head and shoulders pattern. An inverse head and shoulders pattern is a chart formation that appears at the support of a trend with three peaks, where the outside two are close in height and the middle part is the lowest in height. Okay, and it predicts a bullish movement. This is the opposite of a head and shoulder pattern. This one is just inverted, it's facing up, and the head and shoulder pattern is facing down. So the head and shoulders pattern predicts a sell, which is a bearish movement. Then the inverse head and shoulder pattern predicts a buy, which is a bullish movement. Then now we're jumping off to something similar to a head and shoulder. This is similar to a head and shoulder, guys, but then it's not the same as a head and shoulder. Okay, this is called a triple top. All right, a triple top is a chart pattern that forms three peaks that hit almost at the same level of a resistance zone at the end of an upward trend, which predicts an upward or a bullish movement after breaking out of a neckline, which is considered as the first resistance. Okay, guys, but then in this case, now we're talking about a triple top, guys. So this first resistance part is actually a mistake, because the resistance level is the top level, guys. Then the bottom level is actually called the support. So the triple top usually gets confirmed when the market breaks out of a support level, not the resistance level, guys. So as you can see, a triple top actually has three peaks which touch almost at the same level. As you can see, the resistance level is the red dotted line, guys. So that's where the market has to hit 3 times. All right, then by hitting at the same level 3 times, then that is a triple top. But then the only time the triple top gets confirmed is when the market breaks out of the support, which is the neckline, then retests, then shoots exactly down, shoots straight down, guys. That's the triple top. It has to hit the resistance level 3 times. It doesn't matter whether it hits the resistance, then does a fake out, comes back, then hits the resistance again, then it doesn't make a fake out, and then it comes back, hits the resistance, forms a long wick, then it drops down. It'll still be a triple top. So it will not always be perfect. All right, as you can see, the live chart example on the right hand side on AUDJPY. This is the first top, second top, third top. Then here we had a long wick, as you can see. So hence I said it should not hit at the same level, because it will not be perfect, guys. The market is not always perfect. So this is a triple top. Then we have a triple bottom, which is the opposite of a triple top. Okay, a triple bottom is a chart pattern that forms three peaks that hit almost at the same level at a support zone at the end of a trend, which predicts an upward or a bullish movement after breaking out of a neckline, which is considered the first resistance. Now here's the first resistance, guys. The dotted line, the green dotted line, is the first resistance. So meaning in this case, guys, the market actually hit down 3 times. Okay, the market actually hit down 3 times. Then after hitting the support 3 times, we actually broke out here at the neckline, which is the first resistance. Then we hit a retest, and then that's a buy. So basically, the triple bottom is the opposite of a triple top. The triple bottom is the opposite of a triple top, guys. And then here's the live chart example, guys. Here's the live chart example. Alright, as you can see here, we had a first bottom, second bottom, and then a third bottom. But then a third bottom looks like it hit twice, first, second. So basically here it's more like we had 4 touches at the support. Then we broke out of a neckline. This was a fake out, guys. This was a fake out. Then the market dropped. Then it had to break out here at this level. So here we had a fake out, and then here we had a breakout. Okay, I'm gonna teach more about this as time goes by. Then this is the last reversal pattern, guys, for part 1. We have a cup and handle. So a cup and handle is a chart pattern that can help you predict the future price movements, especially bullish movements. The market forms a U shape, followed by a correction. After a breakout of a correction, the market continues with the bullish movement. Alright, meaning the market forms something like a cup, guys. You know, a cup shape, right? So the market forms a cup. After forming that cup, which is a U shape, after forming a cup which is a U shape, it corrects. Then after correcting, you know, after every correction there's always an impulse. So we have to break out impulsively, guys. So after breaking out, that's where we get our buys, after a breakout, guys.